Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 110. This one is titled Exit Strategies Are Important, but Must Be Timed Properly. We're going to be using a real life example with MGM Resorts International, which trades on the New York Stock Exchange under the ticker symbol MGM. Let's first define exit strategies. Well, these are position management tools that we use after entering our trades. In this case, we're going to be using a covered call writing trade with MGM. It's the third of the three required skills that comes after stock selection and option selection. All exit strategies start the very same way, and that's by buying back the original option that was sold. Our goals, easy: mitigate losses, turn losses into gains, or enhance gains. Now, if we were going to take a philosophical approach to what exit strategies are, they are the intersection of preparation and opportunity. So we must be prepared before entering our trades for every possible outcome after we enter our trade. Stock goes up, stock goes down, ex-dividend dates, earnings reports, everything. And this way, if something does occur, and most of the time it won't, but when it does, we'll know exactly what to do. We'll be taking emotion out of the equation, and we won't have to start fumbling around as to, oh my God, my stock went way down. What should I do now? We have to know that before we enter our trades. So here's a real life example with MGM. Now, it starts at 6/8/20. One of our members shared this trade with me. And we're going to go through 6/21/20. That was the time when I was contacted, but it's actually for the contracts expiring on July 17th, 2020. So we're going to take a look at that 6/8 to 6/21 time frame. So on 6/8, MGM was purchased at 23.18, and immediately the July 17th, so about a 5-week contract period, 26 out of the money call was sold at $1.54. I think right away, if you do some quick math, you can see that's a very juicy premium. Now, only 4 days later, that 26 call was closed by the close for 54 cents. Now, 54 cents represents 35% of the original premium received, $1.54. Now, for those of you that are familiar with the BCI guidelines, 20%, 10% guidelines, right off the bat, you'll see that too much money was spent on closing that position. Normally, we wait for it to decline to 20% in the first half of the contract, but it wasn't. It was closed at 35%. Okay. Now, right after closing, there was a sell to open order for the same expiration, July 17th, 19 calls. So it was rolled down from the 26 call all the way down to the 19 call, $7 difference. That's huge. And the premium was pretty juicy, 238 for the rolling down strategy. But really, did this make sense? We're going to get into that. Now, on June 21st, when I was contacted, MGM was actually trading at $17.17. So 9 days later, the price had declined all the way down to $17.17. So let's break down this trade now into 4 categories. First, the initial structuring, the way the trade was set up. Then we'll look at the buy to close order, initiating the rolling down strategy. Then the sell to open, completing the rolling down strategy. And then any exit strategy that was or was not initiated after the sell to open rolling down exit strategy. So those 4 categories. Let's start with the initial structuring. Now, for those of you watching this podcast, we're showing you the multiple tab of one of the BCI calculators. For those of you just listening, I'll describe it. On the left side in the blue cells, we fill in the information. MGM starting at 23.18, selling the out of the money 26 call for $1.54. The calculator tells us that our initial time value return for this 5-week expiration, 6.6%. Now, upside potential, if MGM moves from current market value of 23.18 up to that 26 out of the money strike, there's a possibility of another 12.2% profit in addition to the 6.6. So there is a possible 18.8% 5-week return on this trade. Yikes, that is huge. So what does that tell us? Well, it tells us that the implied volatility at the time of this trade for MGM was humongous. And so the premium was huge. That's the good news. The bad news is when there is a very high implied volatility, that means that the risk to the downside is also great. So we each have to determine what our personal risk tolerance is. Now, for me, I structure my trades at 2 to 4% for my initial time value return for monthly options. I'll go up to 6% in a very strong bull market, but never higher. Now, that doesn't mean this is wrong for every investor. It's right for some. If your personal risk tolerance is high, this could be correct for you. But you have to determine that before you enter your trade. Now let's look at the buy to close trade, where the price point for that buy to close was at 35% of the original premium. I told you, according to the BCI guidelines, that's way too high. So that's something that we have to look at. Now, on 6/21, when I was contacted, that 26 call could have been closed at 10 cents rather than 54 cents. So a little too aggressive on the buy to close side. Now, if we looked at a price chart of this MGM trade during the July 2020 contract, you would see, and those of you watching, I have a screenshot in front of you, but I'll describe for those of you just listening. At the time the trade was entered, it was a very bullish ascending price chart, extremely bullish. But then right after entering the trade, the price of the stock plummeted, and it was rolled down at the 35% price point, almost at its low point on the 12th. Now, the stock then consolidated for a while and then continued to go down again. And I show on the right side of the screenshot where that original call could have been closed at 10 cents rather than at 54 cents. So now let's look at the sell to open trade, which was initiated for the 19 call. Remember, it was rolled down from 26 all the way down to the 19 call. Well, what that did was it locked in a guaranteed loss of $80 per contract, 80 cents per share. When you factor in the stop loss and you factor in the option gain. So that locked in a loss of $80 per contract. Now, we are still early in the contract on 6/21. So closing the short call, we can wait another week to see if the price recovers or create an opportunity to hit a double if it did. But if it continued to go down, we can close our position at a much lower cost, and then we could roll down. Now, after the price of the stock was rolled down, one of the things left out was there was no buy to close limit order set on that new sell to open trade at 238. There should have been a buy to close limit order at 20%. We were still in the first half of the contract. So I would say setting it at 45 cents is a reasonable buy to close limit order. So that left us in a position where we may not be able to manage our trade unless we were watching it full time, 24/7, or at least during market hours. Now, what's done is done, and we must focus in on the positives. So let's just summarize now. What are the positives here? Well, we could see that managing our trades gives us a huge advantage over those who do not. And most covered call writers really do not manage their trades. They know how to enter them, but then from there, it's just prayer. Not the case with members of the BCI community. Now, we've experienced this trade that is instructive on many levels, and there are many lessons to be learned that will put cash in our pockets in the future. So that's how I learned how to do these option selling strategies. I'm way better at it now than I was back in the 90s when I started teaching myself these strategies. And that's because every time I made a mistake, I analyzed it and I made sure that I wasn't going to make that same mistake again. So if you have a losing trade or if you made a mistake on a trade, don't feel that it wasn't worthwhile or that you really messed up. Look at it like it was a learning opportunity that's ultimately going to put cash in your pockets because you've actually learned from this trade. Exit strategy execution opportunities must be implemented when they arise, but the timing of these trades are critical. Before I go, I want to mention to you, as I always do on these podcasts, about our pride and joy, the BCI package, which is our best and most comprehensive educational product. It includes 6 online video courses with downloadable workbooks, 6 calculators found nowhere else because they were created by the blue collar investor. We also have 5 of our best-selling books in ebook format, along with our annual premium membership, which is 13 months of membership. It includes all of the weekly and monthly reports to eligible securities for option selling, along with a huge educational component and always ongoing and never-ending training videos. Right now, there's over 200 of them available on the premium member site. The ongoing video training includes our library of Ask Alan videos, a Blue Hour in-depth webinar series, and we add 1 new training video each month, some months more than 1. Where to find more information on the BCI package? Go to our website, www.thebluecollarinvestor.com, and on the top, just look for the link that says BCI package. Ladies and gentlemen, thank you very, very much for taking the time to listen to and or watch this BCI podcast number 110. Exit strategies are important, but must be timed properly. Folks, I hope you enjoyed this video, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.